This conference will now be recorded.
Hi, good afternoon, everyone. Thanks for joining in. This is our fourth session. We'll be talking about technical indicators. But before that, quickly, an AV check. If you can hear me clearly, just give me a couple of confirmations is good enough to get going. Thank you, Akhilesh, Pavan, Anirban, Rajat. Good afternoon. Thanks. Thank you. So, as we move ahead from where we left yesterday, we continued patterns with candlesticks. Japanese candlesticks did some conventional patterns and then looked into Heiken Nashi, how we can use the Heiken Nashi as an efficient way of trailing stop losses and riding big trends. Today, we will be focusing on technical indicators. Now, this is the area of the subject which got a lot of controversy. Few people prefer the pure price action, that is no indicators, no derivatives of price at all, pure simple raw price charts, that's it. Few swear by using indicators. You'll be surprised, few people may use much more indicators than needed. I am of the school of belief is that we should use only those which we can make use of, not those which are useful. Each and every indicator is useful, but me and you may not need it. And it should be a need-based approach, not a greed-based approach. It should not be an approach where others are using it. I saw a YouTube video, so I should also use it, not like that. And so this area has a lot of controversies. We'll try and approach this, and I will share my beliefs so that it becomes easier for us to break it down and understand how to deal with these indicators. Now, the problem with indicators, okay, let's go to the problem later. Let's ask you a simple thing. When you think of the word indicator, just think of the word indicator. What comes to your mind? Nothing to do with financial markets. I'm just talking general life. If you think of the word indicator, indicators, what do you think? My scooty light, that's really well said by Akhilesh. It acts like a signal or a sign. Homraz, Shayam, Rumkuk, alert, car. Yeah, correct. An indicator indicates, correct? It indicates. That's the work of an indicator. Like you said, the car indicator or the scooty indicator. Why do you give the right indicator when you're driving down your scooty? Because you want to indicate to the rest of the people on the street that you're going to take a right turn. The car behind you should not overtake you from the right. The car which is coming from the front should know that he or she should slow down because you're taking a right turn, and etc., etc. So there's a lot of information, or there's only one information given to a lot of people around which you're trying to indicate. Now, if there's a scooty in front of you who's given a right indicator, what is the chance that he's going to take that right turn? We are quite certain that he or she should, but maybe he gave the indicator a little too early. Maybe he's going to take the next right turn. Maybe he got a little confused. He wanted to take a left, but by mistake he gave a right indicator. So like it happened to me when I first bought my Skoda. Skoda is a German car, and there the indicators are on the left-hand side of the steering. And Indian cars like Maruti will have the indicators on your right-hand side of the steering. So at the beginning, it was I wouldn't say it's very difficult, but it was a little uncomfortable to start off with for the first few days. So I might have landed up putting the indicator when I wanted to switch on the wiper, and vice versa. So an indicator indicates, and yes, we can have a certain degree of belief that it will act as it indicates, but then there is a little scope of error. There is definitely a little scope of error wherein what it's indicating may not turn out to be a fact, or maybe turn out to be a fact, but maybe a little later. The silly example of dark clouds in the sky is an indication that it's going to rain. Now, when I talk about technical indicators or about the market, what is it trying to indicate? When we are now talking in respect to the stock market and charts, fine, indicator indicates, I understand this, but what is it that it's trying to indicate to you and me? So this can be in essentially two ways. One, it is trying to alert, and second, it's trying to confirm. These are the two indications that a technical indicator offers to us. Alert would be, it's trying to alert to us that the trend is likely to go down. It's going up, but it's giving us an alert. Listen, the trend is going up, but sooner or later, it's likely to reverse. That's an alert. Confirm would be, yes, the trend has gone down. It's a confirmation. Again, a simple analogy is the dark clouds is an alert that there's going to be rains. That's an alert. And when the rain actually falls and hits your head, or you can touch the rain, you can catch the rain, that's a confirmation. Yes, it is raining. So alert and confirmation are the confirm are the two main jobs of a indicator, especially a technical indicator. It helps us, it alerts us about the market conditions. It confirms to us about the market conditions. So with this simple understanding, we can start learning about indicators. But there is an issue. The issue with indicators, the issue with technical indicators is spoiled for choice. Or there are too many indicators. For example, if we take a look at the TradingView platform, and if we click on the indicators, the ones which are built in an alphabetical order, any decent technical software will have indicators in hundreds. TradingView happens to have a public library where there will be thousands of indicators. I'll later on show you a Spider Software's list. Over there also will have hundreds of indicators. Now, when there are so many indicators, hundreds of indicators, how do we choose where to start? How do we start? Any suggestion? How do we start? Let's say you'll suggest, okay, I have heard about moving averages. Let's start from moving average. Then someone will say, no, I've heard about ADX. Let's start from ADX. Then someone will say RSI. So how do we deal with this? And even if we start somewhere with 1, 2, or 3 indicators, even if we start somewhere, there are still hundreds more. How do we deal with this, and how do we come to know that which one do I need? Unless and until I experience all of them, how will I understand that which one I need and which one I do not need? And it becomes really difficult, right? It becomes really difficult. And that's why what you need to do, and what my approach, and I suggest this to do, is what you should do is you should categorize. Categorize, what does that got to do with technical indicators? Now I'm going to use a very old example that I've always been using in this session, just to bring in parallels, to draw parallels, to understand the approach. Once we understand the approach, the rest of the flow for the rest of your life, as long as you want to learn about technical indicators, will be easier for you. So let's say on the left hand side, I write names like Fair and Lovely. And let's say I write Fair and Handsome below that. And like this, with your little help, I can probably write 3, 4, 5, 6 more names of creams, they are mainly creams, moisturizer, whatever, which we can call them a fairness cream. Right? So fairness cream over here is a category. And under that category, there are various names of products by various companies. You show me one company in India which is into this segment, and they don't have a fairness cream. They will always have a fairness cream. The main reason it sells. And another product will be hair fall treatment. again because of the reason it sells. It may not work, jiska jana hai uska jata hi hai, but it sells. Nevertheless, so there is a dozen of fairness cream in the market by dozen different companies, and they all fall under the, let's say they all fall under the category of fairness cream. Similarly, let's say on the right hand side, I can write something like Volini, or let's say Iodex, okay, and let's say Relispray, and ice and hot and ice and all that various different types of ointments. Move, yes, thank you. And we can all call them, we can all say that they all fall under the category of, let's say we call it pain relief creams or ointment. Let's use the word cream. They're not always cream, but at times, but they do the same thing, right? So this is another category, the category of pain relief. Is that okay? Now you understand this, so far so good. Now my point is, do you exactly know what is the chemical composition of Fair and Lovely? What comes out of that white tube? No. Do you know the application of Fair and Lovely? What comes out of that white tube? Yes. You exactly know you should put it on your face. You know the application, you don't know anything about it. Similarly, if you come to Move or Volini or Iodex, let's say Move, do you know what comes out of that similar looking tube? I think the tube of Move and Fair and Lovely would be very, very similar. So do you know what comes out of the white tube of Move? Again, your answer is no, never gave it a thought. But do you know its application? Of course, I know how to apply it. So like this, you will notice that there are so many different things in our day-to-day lives which we have no clue about what they are, exactly what goes inside them. But then we know their application. We are more keen on the application part rather than knowing exactly what it is. And so what we do is we knowingly or unknowingly in our lives, to make our lives smooth, sail smoothly, we categorize. You know, a very loose way of using the word categorize, the youngsters will understand this better, of course, is aapka type kya hai? You know, you use the word that what type of guys or girls do you like, or what type of friends do you like, or what type of movies do you like, or what type of food do you like. So these are all categorization. Yeah, if I like Chinese food, then the category of Chinese food is something that I like. So unknowingly and maybe knowingly, all of us categorize. So shouldn't we, and why should we categorize? Because under that particular category, there is so much. Let's say food, under food, there can be dozens of different types of food. Until and unless I categorize, it will be very difficult for me to decide tonight if I'm going out for dinner, where to go. So you get the picture. Same issue probably we are facing with technical indicators now, because so many of it, how do we decide? So shouldn't we also categorize our technical indicators? Indeed, we should. So I will help you in this categorization, and later on in your life, you can move ahead under these categories and learn the rest of the list. There can be 5 to 6, but the three core, the three main are trend, momentum, and volatility. These, according to me, are the three key categories. Trend tells us the trend of the market. Momentum helps us understand the momentum of the market, and whether it's a volatile market or a quiet market, the volatility of the market. Apart from that, you can have sentiment, you can have volumes, you can have, let's say, a relative strength. That's not exactly a category, but sentiment and volumes can be. But when it comes to taking trading decisions, taking a call, deciding upon a trade, putting an order, and taking a bet, a risk, these three are the key. Combine them, it works good, and that's exactly what we are going to do. Again, when it comes to trend, volatility, and momentum, again, we will face the same issue of multiple indicators under the category of trend, multiple indicators under the category of momentum, and also multiple indicators under the category of volatility. Oh gosh, now that we decided and categorized, now under trend, there are a dozen indicators. Listen, let's say you want to use a pain relief, you've got you've sprained your ankle or you sprained your shoulder. Are you going to go to the store and buy all the 12 different pain relief balms and apply one at a time just to see koi na koi to kaam kar jayega yaar? Doesn't work that way, right? You don't buy all the 12 different fairness cream and put one each day just to figure out which one is working. Again, it doesn't work that way. So if there are dozen trend indicators, are we going to learn all the 12 just to get more confused at the end of it? Similarly, if there's a dozen momentum indicators and a dozen volatility indicators, if we approach this, the more the merrier we will learn, then it's going to add on to nothing more than a lot of confusion. So what should we do? Why don't you ask yourself, what should you do if you've got a sprained shoulder? Then probably you will use your move because you've been using it for some time. You probably will use Fair and Lovely and only one cream because you've been using it and it's got the maximum user reviews or whatever. And similarly, you start off with something, you start off with one. So you will get into that category of pain relief or fairness cream with only one, so that you understand that very well. And later on, you can substitute. Let me give you an example step by step. Under trend indicators, what we will do is we will learn moving averages. Simple, yet very, very effective. Relative strength index, or the RSI. A dynamic indicator. Bollinger Band under volatility. Now, this does not mean that moving average is the only trend indicator or RSI is the only momentum indicator and Bollinger Bands is the only volatility indicator. There are many, but we will start off with these three. And what will happen later? What will happen later is, let's take an example. Let's take an example of, let's say you have been using Move. Okay, you have been using the product Move whenever you sprain your muscle. So this time you sprain your right shoulder. You have been applying Move for 2 days, but somehow the discomfort is still there. So your friend or your colleague or some family member or someone observes you're in discomfort, and you tell them that this is what has happened, and let's add some fun to this discussion. And they say that, why are you using Move? I have been using a balm called the BB balm, the Bengali Baba balm. Okay, try it out. You were like, Aghas, you said, what? Is there something like a Bengali Baba balm? Does it really? Is there a product? And they swear by it. They say, try it out. You'll never complain. And so to your like real surprise, today evening you go to the store and you find out, yes, there is something like this. There used to be a small red dot kind of a thing that we used to get when we were small. It used to be Tiger Balm or something like that. I don't know if you still get it. Nevertheless, you pick up this BB balm, you go home, you apply it, and next day morning you're completely fine. You can swing your right arm. And you thank your friend or colleague or family member and you say, wow, man, it worked. Thanks a lot. Fine. You were using a product before. You experimented with a different product under the same category, and you are quite impressed with the results. Now, after 3 months, if you sprain your left shoulder or your knee or your ankle or whatever, which one you're going to use? Are you going to use Move first for 3 days or are you straight away going to use the BB, the Bengali Baba? Well, I can make an assumption for you that you will straight away use the BB balm, right? Why? Again, I'll repeat. You were using one product, you substituted with a different product under the same category, of course. So you don't substitute a Move with Fair and Lovely. Please don't do that. Or you don't substitute a Fair and Lovely with Move. Please definitely don't do that. And then you test and try. What you did, you tested, you tried, and then the final conclusion, you found it better. And so the outcome, you substituted. What if the BB balm did not cause any help? What if it was worse? You'll ever use it? No. What if it was same? Nothing, no change. You may not use it. What's the point of using something which doesn't add any benefit? If this is fine with you, then let's come to momentum indicator, relative strength index, RSI. I will introduce RSI to you. I will show you the basics of the indicator, what we can do at an elementary level. Let's say our program is finished, and after a month's time, you stumble upon a website or a YouTube video or a magazine wherein you come to know about an indicator, okay? XYZ indicator. And in that video or in that journal, it's written really good, and you get really interested to know about XYZ indicator. So you read about it and you find out that XYZ indicator falls under the category of momentum. What it calculates is momentum. So you ask yourself, what do I use for momentum? You answer yourself, I use RSI. And I have read about this new indicator XYZ, which is also under the same category. And so what do you do? Same thing, try and test it out. So you plot, you add this XYZ indicator on your charts, and you check. You check visually. You don't have to do any high funder backtesting and all that. No need. You just have a feel for the indicator. Just visually check that whenever my RSI indicator tells me momentum is high or low, what kind of indication is this XYZ indicator trying to tell me? This might take a little time. You can observe it and experiment with it for some time. And then you can conclude. Whether XYZ is same as RSI, no need to change. XYZ is better than RSI, then you substitute to the new XYZ. Or if it's worse, what's the point of using? So like this, please, whenever you get influenced, whenever you get introduced to any new technical indicator in your career, you will, because there are so many. You will, it has to happen. The first and foremost thing, understand the nature of that indicator. Understand under which category does it fall. Understand, do you need that category or not? Then do a try and test to figure out, do you actually need to add something which you just read about or understood? This will help you to stay away from the confusion of technical indicators. Or else today evening you'll watch a YouTube video, you'll get influenced, you'll put it on your charts. Till it goes right, till you make some money, it's fine. But once it starts to go wrong and you lose money, you will shift to another indicator, and this will never stop. Okay, so with this understanding, with this approach, now we will go on to the first category of indicators, which is trend. And under trend, we will be doing the moving averages, the exponential moving average. But before we do that, any doubts or question pertaining to whatever we discussed so far? Anyone has anything to ask about what we have covered so far? Aditya as an Atul says fine. Pavan is also says it's fine. All right. Clear. All right. So thanks a lot. Let me just quickly take a minute's time, not even a minute's time, few seconds time, and connect with my desktop so that I can show you these indicators on the relative strength sorry, on the Iris Plus software. Is this indicators range bound? The indicators which are range bound, Anil, are called oscillators. We will get into it. All indicators are not range bound. Few indicators are range bound, and those indicators, we call them oscillators. They oscillate. Okay. So this should be 429.951.358. Connect. Okay, so here we are connected to my desktop with the trading with the Iris Plus software. I'll quickly open a chart and get, let me just change the colors so that it's visible. I think you should be able to see this. All right, perfect. Do we need to use all three indicators same time, or any one is enough? Depends on your requirement, what you want from your analysis. If you only want to evaluate the trend, of course, you'll only use the trend indicator, the momentum, the volatility also. But Anirban, what happens is when we add them, all three of them together, they give us a far more clearer picture about the particular chart. We need more clarity. Just by one can you trade? If you ask me, just by any one of them, it's possible. Just by trend indicators, it's possible. Just by momentum indicators, also it's possible. Just by volatility indicators, yes, definitely it's possible. But then if we can do the same trade, if you can do the same act of trading in a little more finer, better manner, without adding complications, you know, we have to draw this fine thin line that we should not cross it, so that it becomes complex and complicated and leads to confusion. So just a subtle use of all three definitely helps, but not necessary. Okay. So with that thought, let's come to trend indicators. The trend is your friend till at the end it bends. So when you look at a chart, right? Say for example, you are looking at my desktop now, this screen. When you look at this chart, just visually, just using our visual apparatus, just our vision, our eyes, we can say that the trend is up. And likewise, if I open up, let's say, the Nifty 50 stocks, all the 50 stocks which make up the Nifty 50 universe, if I just keep on, let's say this is not Nifty 50, sorry, I must have clicked on something else. Yeah, was on the top, right on the top. This is Nifty 50. So let's say if I click on Axis Bank, or if I click on Bajaj Auto, and randomly if I keep on clicking like this, if I ask you to give me answers, what do you think? It's an uptrend or a downtrend or a flat trend? You will find that there will be, at times, no doubt it's a strong trend. Everyone will look at an Asian Paints and everyone will say up, 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 up. But then if I come to a Axis Bank, few will say up, few will say flat. Then let's say if I go to a BPCL, we will say flat, someone will say down. So there's a degree of ambiguity. This is called subjectivity. We are just visually looking at it and we are sharing our thoughts about it. this cannot be objective. Okay, this cannot be subjective. This has to be very, very clear, well defined. Because if we keep subjectivity, there'll be confusion. So the work of a trend indicator, is to clearly, with clarity, without any confusion, help us to gauge, to understand the trend of the market. There are umpteen ways of doing it. There are like many ways of doing it, and none of them are wrong and none of them are right. The stuff that I'm going to show it to you, the approach that I use, and I'm going to show it to you, I'm not going to say that this is the best way. Neither I'm going to say this is the only way. There is no best way. There is no only way. There are many, and we stick to something that has worked best for us. It's exactly the way you use move. There are many, but then why do you use move? Because you've stuck to it and it works for you. It's fine. There's no need to complain. It does my job. As long as it does your job, as long it is fine with you, it takes care of what your need is from the chart, right? So I'm going to share with you my approach after dealing with this for years. So for trend, a very simple tool, very simple, effective, elegant tool is the moving average. An average which is moving, a moving average. Let's take a look at the chart. It will be easier for us when we when we plot them, when we visually see them, it will be easier for us to understand. So let's say this is the daily chart of Nifty. Okay. I'm just going to make some simple adjustments so that most of the chart is visible to you. Okay. So this is a simple daily chart of Nifty 50. This is the bar chart. This is the Japanese candlestick chart. This is the line chart. Line chart shows us only the closing prices. Again, simple but very, very effective. Now I go to S, which will give me the study selection box, which has all the indicators. And I go to A, average. Okay. And under average, there's a lot of stuff, average, this, that, so on and so forth. As of now, we are going to only stick to average, just average. Go to parameter. S stands for simple, and let's make it 2020. And I'm going to give it a thicker colors or darker color so that it's visible. Most of the calculations, most of our calculations under technical analysis of these indicators, the parameter is the closing price. Between open, high, low, close, between these 4 price points, it is observed and it has been accepted that closing price is the most important price. It is something that we accept. And so all the indicators are calculated on the closing price and we add. So you get this blue line, which is blue and red at times. When it's falling, it is red. When it's rising, it is blue. And so this is a 20 period simple moving average. 20 S stands for simple moving average. What does this mean? This means that if I come to this point, okay, if I come to this point, that is the last closing price, and likewise, if I go back 3, 6, 9, 12, 15, 18, 20, I think I did the count right. So from this point to this point, there were 20 trading days. And if I take up the first closing price and I keep on adding all the closing price till the 20th, and if I get the summation, and when I divide it by 20, I get a number. That's an average. This average is this blue line right here. This is a 20 simple moving average. So tomorrow we are going to get a new candle. Tomorrow we are going to get a new candle, which is the 21st day. But then we are only calculating for 20 days. We are not calculating for 21 days. What should we do? Very simple. You chuck out the first day, you reject the first day, and you change to the next day, and you accept the new candle. So from this point to the new one is again the same 20 period. Like this, the moving average keeps on moving. This is the simple concept of moving average. Calculate the average and you make it move, right? If you look at this chart and if you visually compare the raw price, the closing price, the zigzags of the price, and if you compare that with the movement of the moving average, if you compare the movement of the price with the movement of the moving average, what do you see? What do you notice? You will notice that the moving average is far more smooth. It is in the same direction like the price, but the price is doing all its funny ups and downs and volatility and all the noise and etc. And it's going up. So is the moving average going up, but in a much more defined, dignified manner. So it follows price. It's a lagging indicator. It follows price. It follows price, but in a very smooth manner. That's why we take an average. Whenever we take an average, we smooth out the information. The price information, we are essentially smoothing it out with a moving average. That's exactly what we are doing here. Now, couple of important pointers that we should discuss upon. Why did I take 20? How did I take 20? Is there any secret of 20? And why did I take simple? When there are so many different types of moving averages, why did I take simple? So let's deal with the simple moving average first. And then we will come to the parameters. That is 20. So there are various different types of calculating this average. Simple, exponential, triangular, Hull, etc. There are many, many. Let's start with the basics. Let's not do complex stuff. Let's stick to the basic. What is a simple moving average? We understood right now. We took the summation of 20 periods, closing price. We divided by 20 and we got the number, which is this blue line right here. But tell me something. If I ask you that tomorrow's candlestick, whatever it will look like, tomorrow's price behavior, does it have an influence from the last candlestick, the maximum influence from the last candlestick, or the 20th last bar? What I mean to ask you, if I rephrase it, what is going to happen tomorrow has a greater impact from the recent candles or 20-day period, 20 days back candles? It's a very commonsensical thing. You'll know that, of course, what is going to happen tomorrow has a maximum impact from yesterday, from today. So what happened on the last bar affects the most the next bar. Yes, the 20th back bar may have an influence. It may have an influence, but that influence will be very, very minuscule compared to the influence that we will have from the current bar. Agreed. But this is not done by simple moving average. Simple moving average does not consider this. A simple moving average considers all the 20 closing prices are equally important. That's not logical. That's not That's not sense. That doesn't make sense. And so there are various types of weighted moving average. Exponential moving average is one such. So when you come and plot this moving average, remember that in your average type, where you find S, you should keep it, you should make it E. E stands for exponential. We are not going to go into the Excel driven formula of exponential moving average, like we do not want to go into the chemical composition of a move or a Fair and Lovely, but the applicability, the application part of exponential moving average is this: it is faster. It gives maximum weightage to the last closing price, then a little bit more to the last to last, and so on and so forth. As it goes back, the weightages decrease. The 20th day back, or the first day of the calculation, has the least importance. The 20th, the recent bar, 20th bar, has the maximum importance over here. So it is a faster moving average, and it does the work pretty good when we compare it with a simple moving average. Now, let's deal with the 20 period. To deal with the 20 period, I'm going to change the candlestick chart to line chart. Okay. And what I'm going to do, please observe the chart. What I'm going to do is I'm going to decrease this 20. I'm going to reduce this 20 one by one. And we will see, or rather, let me first increase the 20. I'll increase it to 25, 30, 35, 40, 50, 60, 80. And we will see what happens to the nature of the moving average. All right. So let's say I keep on increasing. Now it's 25, 30, 40, 50. This is 60, 70, 80, 90, and 100. This is a 100 period exponential moving average. This value over here considers the last 100 days close, the closing price of the last 100 days. You will notice that the moving average has become really, really slow. In the sense, it's become very flat and slow because it is now considering a large number, which is 100, and it is far away from the price. That is primarily because we have taken a large number, which is again 100. So it's far away from the price. What is going to happen tomorrow will have an impact on the moving average. Of course, tomorrow's closing price will affect the calculation of the moving average, but that effect, that influence will be not much. Even if the market falls by, let's say, 10%, this moving average will not bulge, will not move significantly. It will move, but not significantly, because it is calculated for the last 100 days. Now let's do the reverse. Let's reduce it. Now let's reduce it back to 90, 80, 70, 60, 40, 30, back to 20. Now you find that the moving averages have come very close to the prices. You can see that the moving averages have started to react much more faster than the 100. They are falling even with small falls, so the reaction is much more. If we keep on reducing this, 19, 15, 10, 9, 8, 5, 4, 3, 2, 1. If it's 1, of course it merges with price. It has merged with price. A 2 period moving averages just shifts out. 3, 4, 5. A 5 period moving average is as closely associated with price. See, whenever the price drops, the moving average is also dropping. It's reacting too fast. Even a 1 day fall is leading to a fall in the moving average because my parameter is small, 5 period. So now we have understood, if we want faster reactions, if we want trend, what we are seeking from the moving average, what is it that we are seeking? We are seeking tell us the trend of the market. If prices are above, if moving average is rising, it's an uptrend. If prices are below, the moving average is falling, it's a downtrend. We understand this. We want to know the trend of the market. But then the same answer can be given by a 20-period moving average. The same answer can be given by a 5-period moving average, and the same answer can also be given by a 100-period moving average. Right? So which one should we use? So the way to use is depending on, are you a short-term trader? Then you will use a shorter time frame. If you are a medium-term trader, then a medium time frame, and so on and so forth. You should change. But I have a simple, unique way of approaching it. I have a simple, unique way of approaching this problem. Let me share with you. Once I've explained this, I will then take up your doubts and questions on the moving average concept. So what I have done and what I do is I take a combination of 3 exponential moving averages. Exponential 13, exponential 21, and exponential 34. 13, 21, 34 are the 3 numbers which I've considered. And I'm gonna color them, let's say RGB, red, G, green, B, blue. And I get this 3 moving averages on the screen. RGB, the one on the top, which is red, this one, is 13 exponential moving average. G, which is the one which is in the middle, is a 21-period exponential moving average, and the blue V is 34-period exponential moving average. 13, 21, 34 I have taken from the Fibonacci number series. I will share 2 videos with you today post break, which will detail aspects of the Fibonacci number series, the Fibonacci ratios, the Fibonacci retracements, projections, and extensions, how this esoteric concept can be used. So I did experiment with various combinations apart from 13, 21, and 34. And I found out that 13, 21, 34 seem to fit pretty well in terms of what I seek, in terms of what I want from the charts. So what I want from the charts? What I want from the charts is give me a strong trend, which is stable, strong, it is well defined. Even 1 or 2 days fall or rise does not affect it so much. See, the problem with a 5-period or a 10-period is just a 2-day fall will reverse the trend. And what if the 3rd day it bounces back? So we want to have something which is confirming us. See, the moving averages are not for alert purpose. This is for confirmation purpose. It is confirming to us that the trend is well defined, it is up or it is down. So what we want is on our charts, we want when we find the 13 exponential moving average to be placed situated above the 21, and the 21 is also placed above the 34. We will confirm, we will say that now we have an uptrend. So in terms of your colors, you will see the R to be on top, the G will be below this, the B will be below that, RGB. This will mean an uptrend. The opposite will mean a downtrend for us. 13 exponential moving average placed below the 21 exponential moving average, below the 34 exponential moving average. We have a situation like this, and we will call this a downtrend. On your charts, your R, your red will be 13 will be at the bottom. On top of it will be the green one, and then on top of it will be the blue one. When you have a mix-up, when they are not in order, there is no trend. We will say that there is no well-defined trend. Want to see this on the charts? Let's come here. Let's open our universe of Nifty 50 down here. Okay. Now, when I look at the chart of Nifty 50 right here, if I hide the price, I can clearly see that at the current juncture, it has been in an uptrend, beautiful uptrend for quite some time. Over here for a few days, it had gone through a shift. It got all jumbled up. So there was neither an uptrend nor a downtrend. There was a little bit of jumbled up over here also, not ideal for trading. This is ideal for trading on the long side. So you and I, just looking at the 3 moving averages, we just want to know whether the trend is up, whether the trend is well defined and down, or whether there is no clarity, there is no uptrend or no downtrend in a clear way. There are n ways of finding this answer. Trust me, I'm repeating again. There are n different ways of finding this answer. All of them are right and all of them are again wrong. So do not waste your time looking for the secret. Likewise, over here, it was a well-defined downtrend. In this zone, it was in a well-defined downtrend. Now, if I click on the different stocks of Nifty 50, if I click on the different stocks of Nifty 50 and I ask you the question based on our rules of the trend, will you be able to tell me whether the trend is up or down? All of us will give the same answer if we have understood it. All of us will say that Dr. Reddy is in an uptrend, RGB. All of us will say that Adani Ports is in an uptrend. All of us will say Axis Bank is in an uptrend, very, very close to getting jumbled up, but it's still in an uptrend. Now there is no subjectivity. Now it's very, very clear, black and white. Okay. Now the final thing, uptrend or downtrend. The fact that Maruti is in an uptrend does not necessarily mean buy. It's just giving us a bias. It is just telling us that Maruti is in an uptrend. So we will be more keen to buy than to sell. We will like to trade in the line of the trend along with the flow of the river. So the trend is positive. We would like to be more of a buyer. We would like to be more of a buyer than a seller. So I use a simple storyline to explain this concept of bias to basis. And why we do this, we are essentially done this to create a bias. Either a long bias, that is we will look to buy and trade, or a short bias, that is we will short, or if you don't short, that is if you're not a derivatives trader, you will stay away. Now, before I go to the bias and basis, let me quickly take a look at your questions. EMA can also be used for breakouts. Aditya, EMA is a lagging indicator. It is good for confirmation. Okay, do not use it to trade breakouts. You can use it as a filter to trade breakouts. I'll show it to you. You can use it as a filter to trade breakouts, but price going above moving average or one moving average going above the other moving average, which is called the dual moving average crossovers, don't do that. Why? Because they are slower, lagging, confirmatory indicators. How can you use a lagging indicator to time the market? You should use a lagging indicator to understand the nature of the market. That the nature of the market is on the upside, the nature of the market is on the downside, or the nature of the market is very volatile, sideways. Now, based on the nature of the market that we have understood now, we can deploy what kind of strategy we want to use. It's like, see, in India, everyone understands cricket. And then whenever a match starts, there's always something called a pitch report. They analyze the pitch of the field where the game is going to be held, they're going to play. The pitch plays a very, very important role. If the pitch is hard and it's dry, then it's a batsman pitch. So your strategy will be, let's score as many runs as possible. You will choose your side accordingly. You'll like to have strong batsmen in your team. But then if the pitch is moist and it's a little green and there's overcast weather, then it's not a batsman pitch. You understand what I'm saying? This is like a pitch report. We know Nestle India is in an uptrend. So accordingly, we will strategize. Accordingly, we will deploy our strategies. Okay. Do trend indicators work better with indexes? All indicators work better with indexes. All concepts, every concept of technical analysis will work better with index compared to stocks, because the large number of buyers and sellers help much better price discovery. What's EMA crossover, which you just said? That is one EMA crossing the other. You can see in our screen when we plotted three indicators, there are crossovers. One is cutting the other from above or below like this. These are called crossovers. So crossover of two EMAs is not useful to buy or sell. Crossover of two EMAs can be useful. It's very similar to Heiken-Ashi, what we did yesterday, Akhilesh. It will only yield you returns when there's a big trend. It will only give you big returns when there's a big trend, or else it will not work. It will fail miserably, number one. Number two, a broken watch also gives you the right time twice a day, which means that kabhi na kabhi, if you keep on trading crossovers, kabhi na kabhi aapke haath mein to lamba trend aane wala hai hi na, right? That does not mean you're doing it smartly. But try and understand, Akhilesh and others, that is, if you're trying to get into a buy or a sell, what you're trying to do? You're trying to time the market, right? You're trying to time your entry and time your exit. Will you want to time your entry and exit with an indicator which is lagging, which is slow, jiska main kaam hi hai confirm karna? If you want to go out with your friends to party tonight, will you take a tractor out from the farmland and go out with your friends? No, right? So सबका एक एक जगह पे एक स्पेसिफिक काम होता है. मूव ट्रैक्टर लेके जा ही सकते हो आप, no one stopping you, but will you be doing it in a proper manner? There are better ways to do it, and that's exactly what I'm saying. Moving averages can do the same thing, but there are better ways of doing it. There are intelligent ways of doing it. If you and I use our intelligence a little bit and not follow the herd and not follow what is being told to us, then we can do it ourselves in a much more finer manner. That is what we'll try to do. For intraday, we will need to use leading indicator, right? Not necessarily. I'll come to this point. Hold on. EMA may be applied in FNO trade, yes. Is long-term SMA a good indicator in stocks which plans to diversify or take risk in near future? Not necessarily, Anish. I have tried with 9, 21, 55. That's okay. 9 and 21 means 2 times, a little more than 2 times. 21 and 55 is also a little more than 2 times. This combination looks fine to me. How can we use? Okay. Now, before we move on further, it's very important for us to understand this thing, because this is going to be our approach. What I used here is a word that we are here to create a bias. What we did right here is we created something called a bias. As I understand, as I have understood in my career, that many decisions in life and in trading, it's all about decisions, is a flow from bias to basis, or it can be the other way around. Now, to explain this, I would take a very cheesy example so that you understand, and then we will apply to technical analysis, and then you will understand it better. I need 2 young guys in your 25 to 30, not married. I need volunteers of 2 people in our batch 25 to 30-year-old, maybe towards 30, not married. Akhilesh is there and Srirag is there. All right. So let's say Srirag and Akhilesh are two friends, and both of them decides to meet today evening after the class for a cup of coffee. So Srirag and let's call him Sri. I hope you will not mind. And Akhilesh is a nice name. So Akhilesh and Sri, both of them goes to the nearby coffee shop. Now, in that particular coffee shop, in the corner of that coffee shop, there's a group of young girls who have come, and they're also enjoying their evening cup of coffee. There's nothing wrong in that. Let's say Akhilesh finds one of them particularly extremely pretty and beautiful. Okay, and this is the kind of accidents that happen, which they call love at first sight. So Akhilesh is so sure, so certain about it, that he's telling his good friend Sri that Twada bhabhi beti hai wahan pe. You know, he has literally decided, and it's completely flat on the ground. What has happened is Akhilesh has created a strong bias for that person. Akhilesh has created a very strong liking, a bias for that person. Similarly, if you talk in terms of technicals, or let's say forget technicals for some time, if you talk in terms of the stock market, tell me everyone, what is your bias on TCS or HDFC or HDFC Bank or Reliance? What is your bias? Do you like it or dislike it? TCS, HDFC kind of companies, you like it, right? Most of you will say, yeah, I like it. So if you like it, or I can rephrase the like by saying your bias is positive. If I say your bias on HDFC and TCS is positive bias, then tomorrow the market opens at 9:15, go and buy. Whatever is the price, how does it matter? Go buy, you like it. But will you buy? Of course not. You would like to time it. You would like to know which is the right basis, the right reason to buy. See, I like Infosys, I like TCS. That doesn't mean I'm going to buy TCS at every price. I'm going to buy it at the right price. So one is a bias, the other is a basis. So coming back to the two good friends, Srirag and Akhilesh. Now Akhilesh finds this person very, very pretty indeed. So he's completely sold. Internally, a lot of chemical reactions have happened, and he has created a strong bias for this person. Will this mean that he will get up, go to this person and say, ma'am, I find you extremely pretty, will you marry me? Of course not. It's not going to work that way. So he will try to do some jugaad with the help of social media, with the help of face recognition, and so on and so forth. His entirety will, for the next few weeks, will be devoted to figure out who she is. And somehow, some way or the other, he'll manage. If they are in the same city, somehow, some way, he'll manage and he figures out. And after, let's say, a month's time, they meet each other in some friend's birthday party or whatever. Now, what happens? They get introduced. Okay, looks fine, talks fine, good friends for the last, let's say, 2-3 months now. Akhilesh and his newfound love. Sri, of course, जब दोस्त को प्यार मिल जाता है, दोस्त जाते dustbin में. So Sri, completely forget yourself, you're out of the picture. Enjoy your coffee alone now, or you can go and have some rum. Nevertheless, coming back to Akhilesh now, what is happening is he's spending some good quality time with his love of his life. And what is happening consciously and also subconsciously is checking of bases. Ya aap mano ya na mano, this is happening. You know what? Do we like the same type of food or not? Do we like the same type of movies or not? What is the kind of family backgrounds we have, and etc. and etc. and so on and so forth. Many such parameters are being checked either consciously or subconsciously. So two things can happen. Akhilesh might find her horrible. After just 30 days, the same person whom he found, I don't know, so pretty, and he was so pulled towards that person. After knowing the person, he came back to Sri and said, "Arey, mere liye bhi ram de de yaar," because it turned out horrible. She is a witch. WITCH I used, okay? And you'll say that, no, she's not my type. हो ही सकता है यार. On the other hand, you can say that, wow, Rab ne bana di Jory type. Everything of us, you know, goes on so well. The basis, most of the basis is fine. Ek do khamiyan hai, but that's okay. And after, let's say, 3-5 years of knowing each other, you guys can decide to get married and start a new life. This is called love marriage. Bias to basis. पहले bias create होता है, फिर आप basis ढूंढते हो. And those in our group who have gone through arranged marriage, you would figure it by now. The arranged marriage is essentially a flow from basis to bias. पहले आप सब parameters check करते हो. The family background, कितना कमाता है, नहीं कमाता है, क्या करता है, कितना खामियां है, etc. And okay, fine, everything looks good. Okay, now the boy meets girl. Now in the next 1 month, you guys are going to get married. Now basis is there, whether their bias creates or not, who cares? Basis is there. That's arranged marriage. Now when it comes to trading, we can do both. We can figure out the basis, and then we can write, okay, the basis is fine, and now we are going to create bias, that is, we're going to go long or short on that. Or we can do the love marriage approach also, the bias to basis. But when we're doing it technically, I would say the fundamental way is the arranged marriage way, basis to bias. You look at various ratios, that's checking the basis, and then you tend to start liking the sector or the company. But when it comes to technical, that is essentially when you are looking at price, I think the flow is bias to basis. And what we created right now with this trend indicators over here, right here, is we created a bias, which means whenever we find a chart in a positive bias or a negative bias, Nestle over here is a positive bias. The bias is, am I going to be a long trader in this or a short trader? Am I looking at Nestle to buy or to sell? When we get a positive bias, I'm positive on Nestle. Few months back during this time, I would say I'm negative on Nestle because the bias is negative. Being positive does not mean you buy. Exactly the way I explained that you like TCS does not mean you buy TCS. You like the girl does not mean you go and ask her to marry. So now I like Nestle does not necessarily mean I will buy Nestle tomorrow. Now what it means is, now that I like Nestle, I will now look for basis or reasons based on price reasons to buy Nestle. And what is this reason? This is the basis. And from where will this basis come? The basis will come from momentum and volatility. So the trend indicator is primarily being used to confirm to me my bias. What am I going to do? What am I going to do? And the momentum and volatility we are going to look into is, when am I going to do? Bias is, what am I going to do? Nestle, I'm going to go long. Basis, when am I going to buy that? I know what am I going to do, when am I going to do, bias to basis. And that's why slowly we're going to combine these and look into trading setups. We're going to combine them and create trading setups in our next session. All right. Before I go to momentum, any questions? Any questions? Okay. All right, perfect. Let me take a look at the time. It's 2:41. So what we can do is we can take a break before starting up momentum, which is the relative strength index. Is a very, very interesting and integral part of our setups. It doesn't make sense to take a break in between RSI. Now that we have covered our bias, we'll take a break and we'll then continue with momentum. So it's 41 going to 42. Let's add on 12 minutes to it. 44:54. So around 12:54, I will join you. Yes, TradingView will have these indicators. So around 12:54, let's say 12:55, 255, 255, 255, I'm going to join you back and we'll talk about relative strength index. Thank you. Okay, let's continue. And before we go to RSI, like Sameer's got a question. I sometimes read the price of the share is above 200-day moving average. What does it mean? Or the 200-day is below the 50-day? Okay. So Sameer, what happens is these moving averages are calculated based on a certain period of time, right? Like 200 days or 50 days. Now, 200-day moving average over a period of time for ages has been considered as a good parameter to define a bull market or a bear market. A little more than 200 days of trading happens in a year. So if you have around 20 trading days in a month, you're looking at around 240 trading days in a year. And so somehow, somewhere, someone must have written or analyzed this, that 200-day moving average is the yearly average. And when prices are above the 200-day, it's a long-term bull market. When prices are below the 200, it's a long-term bear market. Similarly, if you consider 200 as your long-term, you can easily consider 50 to be your medium-term. 60 would be like close to a quarter. 20, 20, 20, 60, right? So 50 is considered like a medium-term trend. A 10-day or a 5-day is considered as a short-term trend. And that's how, over a period of time, this theory of moving averages, these concepts have evolved. Now, we will move on to the next concept, that is of momentum. This concept is probably the most popular concept under technical analysis, or for all traders, momentum traders. Momentum is a spurt of buying or a spurt of selling. Momentum is what leads prices to move fast up or down, and traders love it. Short-term traders love this spurt of movement because that is the opportunity to make money in a very small span of time. You can make also a lot of money by holding on to the index for 5 years. But then if you can make that much returns in just 5 days, this kind of return is possible with the help of momentum. You can call it the energy of the market, the flow of the energy. You can call it the chi, the prana, whatever you feel like. This is the energy, the push, the kick, whatever you understand. It is this concept of momentum. Now, I always take this simple analogy to first understand the concept of momentum, and first understand the concept of momentum, why it is useful under technical analysis or for charts, and then evaluate or take it further with the relative strength index. So if you take a cricket ball, okay, this is more like an egg than a ball. If you take a cricket ball and with all your strength, if you throw it up in the air, you go to the ground below and you throw with all your strength up in the air, the cricket ball is going to travel upwards. If you ask the cricket ball, what is your direction? It will say, I'm going up. And then if you check the momentum, the rate of acceleration at which it is going up, that's also pretty high. Means it is covering each and every inch on the upside very, very fast. It's going up very fast. But this continues for a certain height. And after this certain height, the ball continues to go up. It's not that it is not going up. It is still going up. And it goes up, continues to go up till it flattens out at one point of time where it is neither going up nor coming down. Now, during this phase, you ask the cricket ball, what is your direction? The cricket ball says, my direction is still on the upside. But then if you ask, what about the momentum at which you're going up? The momentum is on the downside. The cricket ball is indeed going up, but it's going up at a lower and lower pace. So it's slowing down. And after slowing down, a point comes midair where there is no direction to the cricket ball. It has no direction. Neither does it have any momentum to go towards any direction. And so by the virtue of gravity and all that stuff, the cricket ball, okay, rather than showing it as a price, the cricket ball comes down. This is primarily because of gravity. Not exact, but very similar behavior we find in prices. Gravity will not play a role in the prices, but buying and selling, greed and fear, emotions will play a role in prices. The emotional factor will substitute the gravitational factor in this example of cricket ball. So what happens is when you look at a chart, and let's say the chart is in an uptrend like this, it's going up. You can plot your 3 exponential moving average, all of them are in proper order. And you know what is the trend of the market. You know that the direction of the market is on the upside. And then you can also see a phase in the market when it continues to go up, but then the momentum is coming down. So every phase of the market, every movement of the market, you ask the momentum indicator, are you with the market or are you without the market? When you get differing answers, when the answers are not in the same direction, this is alert. You remember alert, the first slide when we were discussing indicators? This is that aspect of alert that listen, I'm going up, but the rate at which I'm going up is slowing down, which eventually means that I'm going, for me, I'm talking from the perspective of price. Price is talking to you. For me to go further up, it's getting more difficult and difficult. So I will need to consolidate or I will need to correct. Then only can I go further up. This is an alert. And how should a trader read this and what should be his action? He or she should not be buying at this place, because when the price is slowing down, you don't want to buy. You want to buy when it again shows, confirms the kind of momentum. And so for the price, unlike the cricket ball, which only has an option to come down, the price has 2 options, either to come down, which will mean a price correction, or it can go sideways, which means a price consolidation. A price correction or a price consolidation. You will find examples of both, but it's not important what comes next. It's not so important that whether it will lead to a consolidation or a correction, but more so important is this is not the right phase to buy. This is the phase where either I will exit, book out, or at least wait to buy later. This is what momentum does. Momentum is a leading indicator. It gives us indication before the outcome. And this is the primary reason why it is the most favored, popular, sought out concept amongst traders. Traders, not necessarily investors. You need to understand big difference when you're investing vis-a-vis when you're trading. Trading, timing is critical. Investing, timing is not so critical. When you're investing, you might be willing to hold on to the position for 5 years. So after you buy, even if it falls 5, 10, 15%, you do not get so much bothered because you know you have time in your side, on your side. You have the support of time so that this down 15% can go up to plus 115%. But that's not the case for a trader. That is not at all the case for a trader. Trader doesn't have that much time. All that he wants to do is make use of the underlying momentum. hit and run, quick trades in and out of the market, look for the next opportunity. That's trading. So there are many indicators which tries to do this work of momentum: ROC, RSI, Williams percentage R, CCI, and so on and so forth. But I have personally found, and you can also read and do a little bit of research and figure out, that the relative strength index now definitely does the work of your momentum and more. The and more part, we will not go there. It's not part of your curriculum. It's a little more deeper, so we will not go there. But it's a very, very dynamic indicator. I love to introduce you to RSI. RSI is one indicator which I have researched and worked upon a lot, and I continue to do so. And I found merits in that. Literally a very dynamic indicator, developed by Wallace Wilder Jr. This book, this indicator was part of his book, which he wrote in 1978. See, when it comes to indicators, almost all books of technical analysis will expose you to the indicator chapter. But when it comes to momentum indicators, especially this particular book of Martin Pring on market momentum, is something you would love. It's a book on indicators. It's a book primarily on indicators, especially on market momentum. I must have read this book more than a couple of times. It's not that I've not maybe understood the first time, but every time I reread the book, it kind of made a little bit more sense, because I read, I understood, I exercised and experimented, then I had my own conclusions. Then when I reread it, then it tends to make a little more sense than before. So that's Martin Pring on market momentum. And the 1978 book, Wallace Wilder Jr., is this book, New Concepts in Technical Trading Systems. It's a very good detailed book. It's in fact fascinating that this person way back in 1978, and if you read the book, you'll find examples where he uses a simple pencil to calculate RSI, to calculate ADX, to develop these simple yet very, very mathematically effective concepts, approach towards trading. Okay, so this book is the one where J. Wallace Wilder introduces the RSI. It's an oscillator. Aditya is asking about MACD. MACD is a hybrid indicator. MACD, which is a moving average convergence divergence. Aditya, you will find a YouTube video, or you will find one of my videos on my YouTube channel, wherein I have spoken about MACD at length, so you'll find it useful. MACD is a hybrid indicator. It can do the job of the trend, and it can also do the job of the underlying momentum as well. Yes, it can. When we combine MACD and MACD histogram together, it does make sense. That's another approach. I will not look into this in this curriculum, but it's covered in my YouTube videos. You will definitely find it there. So with RSI, but it's not as dynamic as RSI. That's something that I can tell you. The reason why I have used RSI is the key reason of it being so dynamic. So RSI, or the relative strength index, over here essentially is it's an oscillator, or rather, writing it up here, I should write it here. An oscillator is something which oscillates, right? Oscillations. So it has a max, which like a ceiling, which it can never cross. It has a floor, a minimum, which it can never cross on the downside. For RSI, it is 0 and 100. And when you have this kind of oscillations, you'll tend to have an overheated level on the upside and an overheated level on the downside as well. In technical analysis terms, these are called overbought and oversold. Wallace Wilder suggested 70 and 30. Let's take a look at it. Let's take a look at it, and then we will understand RSI better. Let's go to our charts. So when we come to our charts, and we still have this chart of Nestle here with our 3 moving averages. Let me hide this. And I go to S, go to R, relative strength index, select relative strength index. By the way, whichever software you use, whenever you plot the RSI indicator, the relative strength index indicator, you will find that the by default time frame, the parameter, is calculated as 14 days, which you can see on your screen, 14. So what Wallace Wilder did was essentially, I think he took the lunar cycle of around 28 days, took the half of it, 14 period. And so for all due purpose, he has taken 14 period to calculate the RSI. It goes through a formula which ends up looking like this. Let me turn it into a line chart. So on the top, we have the line chart, and at the bottom in red, we have the relative strength index. Before I explain further, let's take a closer look at the behavior of RSI. If you pinpoint any price point, okay, if you bring your focus to any point of price, and you corroborate that, sync it with any point of RSI like this, and from that point onwards, if you keep on looking at the behavior of price, as in what did price do, and in that move, what did RSI do, what happened to the price later, what happened to the RSI, and then when you look at what happened to the price and RSI and price and RSI, and if you do this, if you continue to do this for a certain time, then you will realize that the relative strength index, RSI, essentially mirrors the behavior of price. That is, every time price goes up, even by decimal, RSI will go up by decimal. Every time price comes down, no matter how big or how small the fall, the RSI will also come down. So it essentially tries to match the behavior of price, and it does. At times it fails to, in the sense there's a divergence. We'll talk about that a little later. But an RSI essentially mirrors, copies the behavior of price. But it is calculated, the formula is calculated in such a manner that it can never go beyond 100. It can have a value. So when it comes down, it gives us values of 62, 50, 30, 20, etc. This dotted line over here, is 70. This is the overbought level. And this dotted line down here, this is 30, which is the oversold level. Overbought, oversold. Let's understand these two things. What Wallace Wilder Jr. is trying to tell us is that if the reading of RSI goes to 70, like here, above 70, it means that it's overbought. It means that too much buying has happened. Now, too much buying does not necessarily mean it will fall. Too much buying means it's overbought, and this is maybe not the best price to buy. And then when a fall comes, RSI also falls and it goes oversold. And when an oversold situation comes like this is an oversold situation. It means that too much selling has happened. That's why the stock is oversold. Oversold does not always necessarily mean that the market will go up, but what it means is this is not the best time to sell. We also need to understand that in decision making, when we are taking a decision in our life or in our trading, what not to do is at times as important as what we want to do. What we do not wish to do or have is as important as what we wish to pursue or have. For example, in my personal career, when I was a student and I did not like chemistry much at all, so I very, very clearly knew myself that I'm not going to take up physics, chemistry, mathematics, or statistics, primarily because of chemistry. So I was very, very sure what I do not want to take up. So I went towards economics, statistics, and mathematics. So similarly, in your case also, you would like to know very, very clearly yourself what you do not want to get yourself into, which is decision making. So over here, when it's oversold, or over here when it's overbought, it is an indication of overbuying and overselling, which means what you should not be doing is doesn't make sense to sell here. Maybe wait for a bounce. The prices can bounce back or the prices can fall. Now there has been a lot of work done with this RSI and this level of 70-30, and at times you will find 80-20 to be a good level. And so as per my experience, I would suggest you can look at the 70 and 80 zone on the top, the levels of 70 and 80 on the top, and the levels of 20 and 30 at the bottom can be used as a good overbought, oversold territories when the value of RSI falls below 20. RSI 14 can be changed to RSI any other levels. In fact, in our next class, we will be changing the value of RSI. The parameter of RSI will be changed lower to show you one strategy. But for all due purpose from here on, we will stick to RSI 14 to understand the concept. And later on, we will change it. 60-40, 80-20 rules of RSI is also useful. There are, as I said, many facets to it. Our objective in this sessions is the first step. So rather than confusing ourselves, we'll stick to 70, 80, 20, 30 of overbought, oversold. The important aspect about RSI is the concept of divergences. Okay. The concept of divergence is essentially what we discussed with this cricket ball. The concept of divergence is this part where the direction and the momentum is not in sync. When the direction and the momentum is in sync, when the momentum supports the direction, they're sync, then it's a strong movement, either up or down. But when the sync is not there, when momentum is not confirming the direction of the price, this leads to divergence. So let's look into this concept of divergence. This will be useful in our next session when we talk about a contrarian trading strategy. So RSI divergence, or let's say the divergence with RSI price divergence, is what we will be doing now. Price RSI divergence essentially can be of two types. Let's first do the positive divergence. And then we will look at the negative divergence. We'll put some focus here, and then we will look at many examples and it'll get clear to you. Very important, this part of divergence. Positive divergence comes up in a falling market when the markets are coming down. When the markets are coming down, it generally makes series of lower lows like this, where one low is broken towards the other low, like this. When the price is breaking down like this, of course, you will find that the RSI too is breaking down like this. RSI mirrors price. We have found this. You can do this exercise later with the charts. You can plot the RSI, and you'll find that every low of price and every high of price will match with highs and lows of RSI. So as prices continues to fall and it makes another lower low, it continues to come down and it makes another lower low like this. You would of course expect that the RSI will also come down and make a lower low like this. When it behaves like this, we say that momentum is in sync with price. The momentum is supporting the price. But this may not happen all the time. This may not happen all the time. On the other hand, this can happen, where the price makes a lower low, but the RSI makes a higher low or the same low. That is, the RSI doesn't fall. Price continues to fall, the RSI doesn't fall. When we have a combination like this, it means that the momentum is not supporting the fall. The momentum is not supporting the fall of the market, which generally means that the fall is getting tired. It will either consolidate or it will correct. In this case, it will move up. You will have the case of a consolidation. You can also have the case of correction. This is correction on the upside. In either case, this divergence gives us a single signal of what not to do, that is not to sell. If you spot a divergence on a chart and your advisor or your broker or your friend or someone on the television tells you short this stock or get out of this stock, it's panic everywhere, sell, and you find this divergence on the chart, you know, boss, this is not the price and time to sell. This will stop because momentum is not supportive. We will see enough examples. So this is positive divergence. As we see examples with real charts, it'll get clear to you. The negative divergence comes in a rising market. In a rising market, the market makes higher highs. It continues to break its previous highs, and from one point to the other, it continues to go higher and higher, and it makes a higher high. Like this. As it makes a higher high, your RSI would ideally also continue to make higher highs like this. It also should move from one point to the other and continue to make higher highs. As long as this happens, as long as you have this behavior of price and RSI, you know that it's going hand in hand. It is synced. So the trend should continue, but this may not always be the case. And at times you will definitely see that prices are not supporting the rally. RSI is not supporting the rally. And RSI, on the other hand, rather than making a higher high, it makes a lower high. And so when we get a situation like this, we can see now that the cricket ball is getting tired. We can clearly see that the momentum of the price is not supporting the movement of the price. It's a negative divergence, wherein the prices will stop going up, definitely stop going up, and it will consolidate. It will definitely consolidate before it moves up again, or it can correct. You will see examples of both, either consolidation, which is just stopping for some time and then moving up again, or short-term correction. In either case, as a trader, this gives you a good understanding of what you should not do first and what you can expect going ahead. Let's look at some examples. Once we look at examples, it's going to get much clearer for us. So let's open our price list that we had for Nifty 50, and let's randomly, let's say, open here what, L&T, Larsen & Toubro, it's fine, or Maruti. Maruti is something we were working on yesterday, so let's come to Maruti. So as you see here on Maruti, between these 2 points, there is a clean divergence. It's a positive divergence. Between this point and this point, the price comes down, and between this point and this point, the value of RSI goes up. This is a positive divergence, which led to a short-term bounce back. Now, we will call this, please pay a little attention, we will call this kind of divergence, which we see on our charts, this kind of divergence, we will call this immediate divergence, immediate positive divergence. The reason why I am calling this an immediate positive divergence is because we are comparing this low point with the next low point, and they are one after the other, one next to the other. If I was comparing, let's say, this low point with this low point, then I will not call it immediate divergence. I will call it intermediate divergence, because at this point, the RSI was down here. And at this point, the RSI is indeed higher. Yes, between these 2 points, there is a divergence. Between these 2 points, there is a divergence. And between these 2 points also, there is a divergence. But the difference is, in this case, it is one after the other. It is an immediate positive divergence. However, in the other case, in this case, between this point and this point, there is a divergence. Of course, there is a divergence because RSI has continuously gone up, but it's not an immediate divergence. It's an intermediate divergence. Both are divergences. When you read books on RSI, when you read these theories in these books or in websites or in YouTube videos, etc., you will find that most, if not almost 100% of the examples that are being shown will be predominantly intermediate divergence, like this on the chart. Okay. Now, why am I making this differentiation between immediate and intermediate divergence? Because as we move forward in our next session and talk about trading strategies, our focus, our main objective will be immediate divergence and not intermediate divergence. We will not be looking for, we will not be seeking intermediate divergence. We will be looking for immediate divergence. This is what we want to find on our charts, right? So if you look at this chart of Maruti, sorry, if you come to this chart And if you come to the recent highs, let me check whether it's higher or not. 7109, 7104. No, it's not higher. So can this be applied in any time frame? Yes, this can be applied in any time frame. It can be daily, weekly, monthly, intraday, whatever, any time frame. If you look at this low, Maruti keeps on correcting to this low. Price is getting cheaper and cheaper. But if you look at RSI, from this point of RSI, it continues to go up. So in a falling market, you might continue to see prices going down, RSI going up, and it continues to go down, and then it continues to go up, and then it gives a nice move on the rally. This is the zone, this is the fall where RSI is not supporting. The RSI is not supporting the fall, which means eventually it's going to be a bounce back. Sooner or later, it's going to be a bounce back. So you do not sell here, you look for buying opportunity. Similarly, this is a beautiful immediate divergence down here, where prices came down and RSI went up. One extremely important point which you have to remember, and if you have not been listening to me at all throughout today's session, please listen to me now for the next 60 seconds, is when you look at your charts, when you look for divergences on your charts, always use the line chart. Critical. Do not use the bar chart. Do not use the Heikin Ashi chart. Do not use the Japanese candlestick chart. Use the line chart. This is extremely important. The line chart, when you use it, you will be able to compare. You will be able to understand these divergences far better than otherwise. Is Nifty creating a divergence or not? Let's check. So if you change this to Nifty, so if you can see here, there was a little bit of divergence here, which never actually led to any kind of fall or rise. The markets was very, very high on momentum. It keeps on rising up. And now if you see, let me check, 13,774, 13,763. So as an analyst, don't first jump into conclusions and trade, okay? As an analyst, the flow is like this. We open a chart. The chart is past historical behavior of price. And first we analyze it to make sense out of it. And if it makes sense to us after the observation, we can make some conclusion. And those conclusion can be actionable or non-actionable. So request, do not always jump to action. Do not always jump at every trade, at every chart that there has to be a trade. So if I'm analyzing Nifty, not looking to trade, first analyze. And if the outcome of the analysis is a trade, I will trade. If I analyze the Nifty, I see on a closing basis, Nifty has marginally gone up. Indeed, but if I look at RSI, it has distinctly come down. So is this a negative divergence? Indeed, it is a negative divergence. Does not necessarily mean it will fall. Does not necessarily mean also. So ideally what it means, the first thing, what it actually means, first thing, it is getting tired. This is a sign of the momentum not supporting it. It is getting tired. If it is getting tired, would you like to buy or get into a stock which is getting tired? Question mark. No. So you will not be very, very bullish on Nifty right now. If you're not bullish, does not necessarily mean you're bearish. So if it can go 100, 200, 300 points more further up, it can, it may. But that is the rally which you don't want to participate. That's number one. Number two, eventually, this means that Nifty is getting tired. I don't want to participate on the long side from here on. I would see what it does. It has two options. It will either consolidate, make a range for itself, then the next move up, or it will correct. This is my analysis. And then I'll look for reasons to trade this. This is something I'll cover next class. This cannot be covered in this session, but how to trade, can there be a trading opportunity here? The answer is yes. How should we trade that? This is something I'll cover with you tomorrow, not tomorrow, in our next session. But the analysis first. So you're right when you say that, is Nifty currently showing a negative divergence? The answer is yes, it is. But the bounce after the divergence is uncertain. Yes, everything, Aditya, is uncertain. Let's accept this. This is, if you accept this faster, as in wholeheartedly you accept this, it will be easier for you, that each and every moment, each and every movement in the markets and prices are uncertain. Anything and everything can happen. We need to prepare ourselves accordingly, right? So let's look into some other stocks. Let's say we look at ICICI Bank. If you look at ICICI Bank here, was it creating intermediate divergence? Indeed, it was creating intermediate divergence. So till this point, everything seemed to be fine. So from 500 to, let's say, 520 onwards, it did go up. Of course, it went up. But then all this while, do you see this drop in momentum? What does it mean? It's slowing down, and see, it's not kind of giving this kind of sharp movements on the upside. That's ICICI Bank. Let's look into some more examples. Maruti we have seen. Let's say SBI Life. Nothing much in SBI Life. State Bank of India was slowing down very clearly. You could see these 2 points. Slows down. This is State Bank. This is Infosys. Now Infosys is distinctly higher in price. There was no sign of divergence per se. Is it getting into a very big divergence, like from this to this, from this to this? Yes, indeed, but this is so far-fetched. This cannot be distilled into a trade. That's why I said some time back, I mentioned, and we differentiated between immediate divergence and intermediate divergence. If you recall, differentiated between immediate divergence and intermediate divergence. And that's why I personally do not prefer these intermediate divergence, because it's so very difficult to trade them. Because these intermediate divergence can last for a few days to weeks to months. So it becomes very, very difficult and loss making to trade these kind of silly divergences. On the other hand, it is the immediate divergence which is far more tradable. We can have clarity and trade them. Okay. Akhilesh is saying, can you please repeat the difference between immediate and intermediate? So Akhilesh, okay, maybe you've not been paying attention at that point, but I'll repeat again. No issues at all. Just hold on a minute. Let me find a good example, a different example. It's always good to look at different examples so that you get some clarity. So Tata Steel has an immediate divergence, and in the same chart, can I get an intermediate divergence? Yes, it's there. So let's look at Tata Steel now, Akhilesh. If you look at Tata Steel, and if you compare this high point and you compare it with the next higher point, which is this one, it's higher, right? This one is higher than this one. But then if you look at the readings of RSI, which corroborates with these highs, these two high points corroborates with these two high points on RSI. The RSI's value is lower, the price value is higher. This is a negative divergence. Negative divergence. And when you further look into it very carefully, you see that these 2 points are one after the other. So this is an immediate divergence. This is next door neighbor. This high point is next, very next to this high point. They are like next door neighbors, one after the other. Immediate divergence. But then when you look at something like this, say for example, this and this indeed went up, this to this indeed came down. This is also divergence. Same concept, price going higher, RSI coming lower, is also divergence. But then when you look at this high and you compare with this high point, you will notice that there are other high points in between. So this point and this point is not one after the other. There are other high points. This is an intermediate divergence. Let me show you some more intermediate divergence. Immediate, of course, you have understood, one after the other, one after the other. Let me turn this chart into the weekly chart. You look at the weekly chart of Tata Steel now, and if you look at this low point and you look at this low point, has it been coming down? Of course, it's been coming down. Indeed, it's been coming down. But then if you look at this RSI with this RSI, it's been going up. Yes, it's going up. So is this divergence? Yes, it's divergence. Immediate or intermediate? It's intermediate in nature, because between this low and this low, there are various other low points. This is an intermediate divergence. On the very same chart, now if you look into this and this, did it come down? Yes. Did it go up? Yes. Did it lead to a bounce back? Yes. Is it intermediate or immediate? This is immediate, because the 2 lows were one after the other, one after the other. In this case, not one after the other. In between these two, there are various low points. That's the difference between immediate and intermediate divergence, Akhilesh. Okay. Can these be traded in reality, and which time frame is this? Of course, they can be traded in reality. I'll show it to you how to trade them in our next session. It's going to be part of our contrarian trading setups. If it is not possible in reality, then we wouldn't have wasted time, both of us. So it's highly possible. Okay. Number one. Number two is, going forward, when you look for these divergences, when you find these divergences, do not start to create movements in your mind immediately. Do not always think they are going to lead to a big rise or a big fall. First and foremost, what it means is the rate of selling or the rate of buying is going to slow down. Number one. Then if the price confirms that, for example, in this chart, between these 2 points, there is a divergence, which means the rate of selling should slow down. So I'm not going to sell. If the rate of selling slows down, will it lead to a buying? Will it lead to a bounce back? If it leads to a bounce back, then prices will slowly start to go up. And once it starts to go up, I will wait for confirmations. Yes, the rate of selling has slowed down. The prices have started to go up. Now I can expect a bounce back and trade. So we are not going to, let's say, the way Akhilesh has put in, can it be traded in reality? So let's talk in terms of reality. Is we are not going to trade the divergence. No, the divergence gives us a possibility. The divergence creates a platform. And if the platform is strong enough, and if it confirms a movement, we participate in the movement. So we are always price traders. We are always trading price action. We're taking the help of the divergence as a support. We are not trading the divergence. Because if you blindly evaluate the divergence, or not blindly, if you evaluate the divergence, you will find that half of them lead to a reversal, half of them don't lead to a reversal. The same story that we found with Heiken Ashi yesterday. And this is something that you will find with most of the aspects in the market, not only technicals, even in fundamentals, you'll find that, array, iska ratio to acha hai, then why is the value behaving like this, and etc. etc. Nothing is sacrosanct, nothing is right all the time. And of course, nothing is wrong also. So it's going to be in a phased manner, in a processed manner, step by step, which I will cover in our next session. So how to make use of them, how to actually trade them. Sridhar is saying 17th and 18th Nifty 1 hour chart shows immediate divergence which caused a big fall, sir. Why don't you, Sridhar, if you figure it out, take a screenshot and share it in the group. Why keep it to yourself and bounce it off with me? It's always good if you find such an example, share it on the group. Others will also benefit. Okay. Aditya is asking, how is stochastics RSI different from simple RSI? Stochastics RSI is different. It considers the concept of two indicators, stochastics developed by George Lane and RSI developed by Wallace Fielding Jr. And it's different. So let's not go there right now. Okay, we'll stick to RSI. So this means we should wait for at least strategies classes. Well, I guess when you enroll for the program, it did talk about 7 sessions with me, right? I hope you did not expect to start trading on the first session, is it? Was it like that? So of course not. I always suggest and I request, at times I have to in fact beg to the participants that don't get carried away and start to trade after the first class or second class. Wait for whatever I have to say and share and explain. And once my part is done, that means I'm shared, then you start to trade, at least paper trade, evaluate for some time, visualize the trades, understand how the trades look like on the charts, and then start to trade. So this means that yes, ideally you should wait. If you ask me, you should wait, or else you can go ahead, give it a try. Atul is asking about, are we going to study Bollinger Band today? Let's take a look at the time. Now, Bollinger Bands anyways comes a part of our hook strategy. So I can take it up in our next session when we talk about hook. That's not a problem. So in 10 minutes, it's not going to be justified to rush through and hurry through the Bollinger Bands. Not an issue. Many sessions I generally take a Bollinger Band in the fifth session when we talk about trading strategies. I asked you a question in the first class, which you said that you would like to answer after the fourth class. That is today. Perfect. My question was, why do you like to use the hollow candles? Okay, perfect. Why do I used to like the hollow candles? So these are the hollow candles. Okay. And I pay a lot of attention to RSI, relative strength index. Okay. Now, relative strength index, as we discussed today, is a momentum indicator. And I need to understand whether the direction, the movement of price is supported by momentum or not. That's the main core job of a momentum indicator, which means I have to compare price and momentum every step by step manner. Okay. And for that comparison, a line chart gives us the maximum clarity when I'm comparing a line chart. Correct? You should be with me so far, so good. Now I have to toggle between the candlestick chart or the bar chart and the line chart. Every time I want to do this, I have to keep on doing this. But what if I use the hollow candles and not conventional candles? The conventional candles and the hollow candles are little different. If I use the hollow candles, then the lows and the highs will match with the line chart. The hollow candles lows over here, the red lows, the green highs will match with the line chart. And this is the reason why I tend to use the hollow candles and not the conventional candles, because the hollow candles visually, it takes a little time visually it gets adjusted. It gives me a clear indication, clarity about the highs and the lows, which a line chart depicts or the line chart shows. Nevertheless, even if I'm using the hollow chart, it has become like a habit. It has now become like a autonomous habit that I always tend to toggle and check with the line chart once. Okay. So relative strength index, RSI, is our momentum indicator, and it matches the behavior, the movement of price. It's a excellent tool to compare whether the momentum is supportive or not supportive. As long as it is supportive, it works really good. As long as it's not supporting, that is whether these divergences are formed. I would request you to go through as many charts as possible, stick to the daily time frame, stick to large cap stocks, turn them into a line chart, and try and spot these divergences. Even if you find some failures, it's also important to mark these failures as well. So we did the moving averages and we did the 13, 30, 13, 21, 34. Now I did tell you today before that 13, 21, 34 has been taken from the Fibonacci number series, and this Fibonacci number series has some degree of influence on technical analysis. Let me take you to my YouTube channel. And over here, RSI should be covered in learn technical analysis, right? Okay, first let me tell you about Fibonacci number series, then I'll talk to you about RSI. So you come to YouTube and you, let's say you type my name and you type Fibonacci. Okay, you will get the first video, which is this one, Fibonacci series and financial market explained in details. This is part of the Elon Markets YouTube channel now. So this is the video. Copy, and I'll share it with you here. This is the video which will guide you through the basics of Fibonacci. The basics. Okay, what is the Fibonacci number series? How it is? How are the Fibonacci ratios derived from the number series? What are the various different types of supports and resistances? In stock market, right? Okay, so there's an ad which is coming up all the time. So just jump that. The first video, Fibonacci series and financial markets explained in detail, should be detailed. This talks about, this is what, 1 hour video on the basics of Fibonacci number series, how the ratios are calculated from the number series, what is Fibonacci retracement, and what is Fibonacci projection extension. How can you find support resistance using Fibonacci? How can you find targets using Fibonacci? This is number 1 video. Number 2, when you're done with this, you can jump to the next video, how to predict Nifty's target in 5 minutes. This was, I guess, a webinar which I took in 2017. This is also more than an hour video, 1 hour 7 minutes. So we are talking about 1 hour and 1 hour 7 minutes, together 2 hours 7 minutes, as good as a full-blown class. If you watch these 2 videos in this order, one after the other, in this order, the first one first and the second one next, then how is Fibonacci utilized using technical analysis? To a lot of extent will be clear. You will be able to use. Do I use Fibonacci? For medium to long-term price levels, I use it. For a trading perspective, no, I don't. I don't feel the need to use Fibonacci for short-term trading, because I think it's more useful for medium to long-term levels. Number one. Number two, in my YouTube channel, there happens to be few videos on RSI. When you go to the playlist called Learn Technical Analysis, there is a video over here, which is Profitable Technical Analysis, Divergence, Classical and Hidden. And there will be two videos on divergence in Hindi. Okay, the Hindi playlist is this one. So you'll have RSI classical divergence, RSI hidden divergence. Now, what we did is the classical divergence. Hidden divergence is a divergence which is hidden. It's not part of your curriculum. That's why I have not explained it to you. Number one. Number two, the hidden divergence is tricky. It's a little tricky on the eyes. Classical divergence, which we discussed today, is relatively easier on the eyes. You should be able to spot them, find them, evaluate them, maybe analyze them well and trade them. Hidden, exactly like the name has been given, it stays hidden. It needs a little expertise, a little more experience to spot them. So if you happen to watch this video, I would suggest not to watch the hidden divergence part, But even if you watch it, do not get carried away. Do not try to use them right now, especially if you're new to the subject. Those who are, let's say, learning about technicals and charts for some time, and this is not your first course, you understand all these concepts, give it a try, give it a shot. But if you're new, do not. Unnecessarily, you will feel a little bogged down. It will get complex. So we'll break it down into smaller parts and we'll take it one after the other. So feel free to go through these videos. How to decide EMA days? So we decided it for you, 13, 21, 34. I think you were there very much in the session when I was talking, and I did write it down for you. I did plot it for you. I did show it to you. So it's 13, 21, 34. So maybe you were not there or you missed out. So this is how the days of the EMIs are calculated. How did you decide? So I picked it up from the Fibonacci number series. The number series is 0, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233. So from there, I picked up 13, 21, 34. See, the 21 happens to fall in the middle, which on the daily chart happens to be the monthly average. The 13 is very close to 10, which happens to be 2 weeks. Okay, so the first two of the 13, 21, 34 is pretty useful. 13, 21, 34. And so I've stuck to this sequence of 13, 21. As I said earlier, I have experimented with other combinations. I think someone mentioned he has used 9, 21, 55, I think you mentioned. So you only. So it's more or less, it boils down to more or less the same thing, Deep, right? So you can try it out. You can plot on the same chart, both of them in two different charts, and figure out. You'll find more or less it will not give you huge difference, right? So what are we going to do now with this understanding of trend and momentum, and especially divergence? We're going to move on to our next session next Saturday, 1:30, and we are going to build trading strategies, setups. Now, whatever we have learned so far, we will take the next step to monetize them. We will look for particular setups which are tradable, practical aspects. Now we will take actions based on them. So volatility will come under that. Bollinger Band will cover it with the hook strategy, but that's for the next session. I request for the next week going forward, habituate your eyes with the charts and look for divergences, plot the 13, 21, 34 and practice. Make sure you get the Iris Plus software installed at your end. All right, time for me to sign off. I'll catch up with you again next week, 1:30 Saturday. Till then, enjoy your week ahead. Thank you and God bless.